honor to lead this committee for the last 2 years, and I'm particularly proud of the work we've done to illuminate risks to the federal budget. In our first hearing in this committee on February 15th, 2023, I brought with me this binder. I have it again with me today. Nearly 7 years ago, I sent a version of this binder to all of my Senate colleagues, in which I compiled some of the most compelling warnings about the economic risks associated with climate change. At the beginning of this Congress, I sent to the committee this updated version of it. Today, this binder is even more relevant than ever, and I'm continuing to update it with what we have learned over the past 2 years of hearings. Examining the economic risks and costs of climate change and the economic opportunities from investing in clean energy, we repeatedly heard about the central role that insurance affordability and availability play in our economic system. When insurance becomes unavailable, it can be impossible to get a mortgage. And when the pool of buyers is limited to those who can pay cash, that's a lot fewer buyers and property values suffer. Multiple witnesses drew parallels to the 2008 financial crisis. So, the committee launched an investigation into homeowners insurance market conditions across the country to better understand the troubles affecting the market. The committee focused on non-renewal data, as insurance industry experts had indicated that spiking non-renewal rates, even if still low in absolute terms, are often an early warning sign of market destabilization. Higher non-renewal rates are also correlated with higher premium rates. Well, today we release that report, boom, with brand new information about the key questions of when and how bad this will get. The answers are now and very, and it's only getting worse. I would make one comment on the data that we relied on. I have a letter from the NAIC suggesting that some of the data that we have might have unidentified inconsistencies and inaccuracies. I will put that letter into the record. We will continue to pursue with the NAIC what they mean by this letter. And if we need to make adjustments to the report, we will correct the report accordingly. It's a bit of a mystery to me because they don't identify where those inconsistencies and inaccuracies are, what they might be. And we worked directly with 23 insurance companies to get their data, and not one of them indicated that they had any concerns about inconsistencies or inaccuracies in the data they were providing us. And around half of them submitted their data to us through the Milliman firm, which is perhaps the most respected and well-regarded professional consulting and analytics firm in the insurance industry. And so that data was also compiled and combined together by Milliman, which also has not indicated that it has any concerns about inconsistencies or inaccuracies in the data. We've been at this for many months now, and this came in just at the last minute, so I've made the decision to just go ahead with the hearing, and I have confidence in the data, and if it turns out that there are any inconsistencies or inaccuracies that we need to adjust for, we will then do so. This report is based on national, county-level, non-renewal data from almost 24 insurers who together represent approximately 2/3 of the homeowners insurance market. So it's a big data set. Here are a few highlights. First, the data confirm that climate change is driving increasing non-renewal rates. The counties that are most exposed to climate-related risks, such as wildfires or hurricanes, are the counties seeing the highest non-renewal rates, especially counties in Florida, my friend Senator Kennedy's home state of Louisiana, and California. Second, the data reveal that those areas are not the only places experiencing spiking non-renewal rates and increasing premiums. Florida, as we would expect, has the highest average statewide non-renewal rate. But Texas, thought to be at significant risk, is not even in the top 10. Southern New England, the Carolinas, including inland North Carolina, Mississippi, New Mexico, counties in the Northern Rockies, Oklahoma, and Hawaii all suffer high non-renewal rates, demonstrating that the multiple climate-related effects, hurricanes, wildfires, severe convective storms, extreme precipitation, and sea level rise, are destabilizing widespread insurance markets. Third, the data confirms a correlation between rising non-renewal rates and rising premiums. This underscores our evidence that climate change has become a major cost of living issue for families across the country. Since this data was collected, climate change-driven extreme weather events have wreaked havoc across Florida and the southeastern United States, likely exacerbating the insurance crisis that is building across the country, but that data is not included in this set because it all happened since the set was closed. One thing is certain: unless the United States and the world rapidly transition to clean energy, climate-related extreme weather events will become both more frequent and more violent, resulting in ever scarcer insurance and ever higher premiums. This is predicted to cascade into plunging property values in communities where insurance becomes impossible to find or prohibitively expensive, a collapse in property values with the potential to trigger a full-scale financial crisis similar to what occurred in 2008, according to the chief economist of Freddie Mac. Only, unlike in 2008, these property values will likely never recover because the risk is not going to go down, nor will the sea levels. Climate change is no longer just an environmental problem, is our conclusion here. It is an economic threat, and it is an affordability issue that we should not ignore. I will close where I began around 2 years ago. My granddaughter, Vera, who was then 1 year old, is now nearly 3. I said then that I was hopeful that by the end of our series of hearings, if we hear these expert witnesses, if we treat their testimony as our headlights, then our path would be clear. I hope that path has become more clear. I'm not sure what I now have to say to my granddaughter as climate-driven extreme weather events and the economic shocks that come with them continue to worsen. We really need to get this right for the sake of our planet's natural systems, for the sake of American families and their prosperity, and for the sake of future generations like Vera's. And let me conclude my remarks on this last of our hearings by turning the mic over to Ranking Member Grassley and thank him for his many courtesies through these many hearings. He has not always agreed with the points of these hearings. His staff have often disagreed even more with the points of these hearings. But we have worked through a great number of issues, and Senator Grassley is one of the most courteous members of the Senate, and it has been a pleasure for me to have him as our ranking member through these 2 years. With that, over to you, Chuck.
I was hoping you wouldn't say that so I could say it to you first, but
I get to go first for a while.
I want to say that I associate myself with your remarks from the standpoint of Chuck Grassley appreciating our relationship, even though we've had some differences. But we serve on other committees together. And
We do.
We don't have those same differences there. So I hope people understand that even if we have approached this committee with a little different approach, that we still get along and can work together.
And we've done good work across Judiciary, Finance, and Budget committees. So it's a pleasure. To you, sir.
So, repeating a little bit what I just said, our time at the helm of the Budget Committee is coming to an end. Disappointingly, it's ending in the same way it began, not focusing on our nation's unsustainable debt and deficits. Instead of prioritizing the committee's core responsibilities, here we are holding the 21st hearing on climate change. I agree, climate change is a serious issue, meriting discussion, maybe in other committees as opposed to this committee. but it's difficult for me to take seriously a report that the president has talked about that the majority chooses not to share with all members of the committee before the committee meeting. So today's hearing is not a discussion on the merits. I remain convinced that the Budget Committee should be focused on the immediate fiscal problems facing our country. The American people evidently feel the same way. The majority invited left-wing film producers, consultants, luxury fishing guides, snow skiers, and other non-scientists to give us the top opinion in the course of their 21 climate hearings. Their testimony used studies rooted in extreme climate change modeling that failed to convince anyone of an impending doomsday, climate doomsday. Fortunately, over these 21 hearings that we've had the last 2 years, minority witnesses, those that I choose to put at the table, gave us actual scientific and economic expertise, testifying to debunk many of the underlying assertions of climate-driven fiscal collapse. Moreover, the majority continues to ignore the nonpartisan CBO analysis, finding that negative economic effects of climate change are dwarfed by those proposed by our ballooning national debt. I understand why the majority won't talk about our nation's fiscal trajectory. After all, that would require acknowledging the past 4 years of reckless spending resulting in a 40-year high inflation, and that inflation continues to wreak havoc in the lives of middle-class Americans. That negligent malpractice on the part of the majority cost them the presidency and both houses of Congress. Instead of addressing the concerns of Americans head-on, President Biden and his party attempted a strategy of deception and distraction. First, Democrats told the American people that inflation was transitory. I hope you remember that. That was in 2021. And that being transitory, it was nothing to worry about. Once it became obvious this wasn't true, they took their far left spending agenda, which sparked inflation in the first place, and repackaged it as if it were some sort of a cure. Out of this, we got the ill-named Inflation Reduction Act, which even President Biden later admitted was less about fighting inflation than it was enacting their coveted Green New Deal. And of course, CBO confirmed that bill actually increased inflation instead of reducing it. The Inflation Enhancement Act, as I prefer to call it, along with President Biden's expansive executive orders, flooded the economy with trillions of additional deficit spending, hardly a recipe for taming inflation and tamping down the rising cost of living. Bidenomics, as the president later rebranded it, was a colossal failure. Given this, there was little else to be done other than to change the topic to anything else, whether that be abortion, trumped up legal charges against a political rival, or the existential threat of climate change. Despite this very loud message Americans sent in November, today's hearing is more of the same. Rather than admit inflation fueled by reckless spending caused insurance premiums to spike, climate change is used as the main scapegoat. Never mind that historic inflation caused the cost of building materials to rise nearly 40% since 2020, Given the impact of inflation on insurance costs, our time would be better spent exploring options to rein in 2 trillion annual deficits and a national debt that recently topped 36 trillion. I had a good meeting with Finance Minister of Sweden last week. Sweden's fiscally sustainable policies have near unanimous support across party lines and enjoy broad-based public support. Their fiscal framework establishes an annual deficit or surplus target, incorporates a debt anchor at 35% of GDP, and sets a reasonable expenditure limits. I would have liked to see this committee spend more time this Congress exploring innovative approaches like this to address our fiscal mess. We barely spent any time. This committee needs to move on to 2025 priorities, getting our fiscal house in order. Mr. Chairman, I wish you and your family a Merry Christmas and a Happy Holiday. Same to our witnesses all here today. And we'll join in the new year working together on the Judiciary Committee.
I look forward to it, which you will be chairing. I look forward to it, and I guess time will tell who's been right about climate change, so there's no point having that argument here. Let me introduce our witnesses. Dr. Benjamin Keys is the Rowan Family Foundation Professor of Real Estate and Finance at the University of Pennsylvania's Wharton School and a faculty research fellow of the National Bureau of Economic Research. Among other things, Dr. Keys' research focuses on climate risk, housing, mortgage markets, and the geography of household financial distress. Welcome, Dr. Keys. Good to see you back. Our second witness is Mr. Ernest Shigalian, an insurance agent at Butler and Messier Insurance Agency in Pawtucket, Rhode Island, and a past president of the Rhode Island State Association of Independent Insurers. Mr. Shigalian has been working in the insurance industry as an agent for 40 years in both the Rhode Island and Massachusetts insurance markets. Ernie, it's wonderful to see you down here today in Washington. Finally, we have Dr. Robert Hartwig, Clinical Associate Professor of Finance and Director of the Risk and Uncertainty Management Center at the Darla Moore School of Business at the University of South Carolina. His research focuses on insurance markets and structures and risk management, among other things. Previously, he was president and economist for the Insurance Information Institute. I thank you all for being here today. You each have 5 minutes for your oral statement. And before I turn it over to Dr. Keys, I'm just going to take a Rhode Island moment and go back, 30 years now, to when the Rhode Island workers' compensation system collapsed, which gave me some familiarity with insurance collapses. And I, as a young staffer for the then governor, was handed the portfolio of fixing that mess. And Mr. Shigalian was one of the leaders of the insurance industry who helped work us through to a resolution of that crisis. We basically rebuilt the workers' compensation system. Within the next 5 to 10 years, the cost per hour of payroll went down by 50%, and employees were extremely happy, did not take benefit cuts. It took process improvements to make that happen, and to this day, the workers' compensation system is running smoothly in Rhode Island, and other distressed workers' compensation systems around the country turn to us for lessons still. And so it's a particular delight to have Ernest Shigalian here with us. Dr. Keys, to you.
Chairman Whitehouse, Ranking Member Grassley, and members of the committee, thank you for inviting me back to address the turmoil in insurance markets, its connection to climate change, its effect on housing, mortgages, and household well-being. My name is Ben Keys, and I'm a professor of real estate and finance at the University of Pennsylvania's Wharton School. My research agenda examines how households interact with the financial system and how the financial system manages risk. I first testified before this committee in March 2023. In the last year and a half, the situation in the homeowners insurance market has gone from bad to worse. Both affordability and accessibility issues have reached a crisis point in many communities around the country. In terms of affordability, my new research with Professor Philip Mulder uses mortgage escrow data to build a data set of 47 million homeowners insurance premiums from 2014 to 2023. Our data set shows rapidly increasing premiums across the country, but especially in the highest climate risk areas. We attribute this increase to a combination of inflation and financial frictions associated with the pass-through of rising reinsurance costs to homeowners' policies. Insurers are responding to larger realized disaster losses, better data and risk models, and growing reinsurance costs. While raising premiums is one margin of adjustment, insurers also change where they are willing to write policies. Some of the largest insurance companies have exited markets, deciding that they cannot charge premiums that adequately reflect this growing risk. While many of these high-profile departures have been publicly announced, all insurers continually reassess their risks and adjust their portfolios of policies in force. Turning to the issue of accessibility, the data collected by this committee provide an unprecedented look at insurers' decisions to not renew an annual policy. To my knowledge, there are no available granular data on non-renewal behavior beyond the data collected by this committee. This new data covers 249 million policies from 2018 to 2023 and yields a number of striking findings. First, since 2020, the average non-renewal rate has almost exactly doubled. These rates and their increases are highest in those areas with the greatest risk of climate-related disasters. Next, while Florida and California are seeing the highest rates of non-renewals, they are also prevalent in high-risk coastal areas like the Carolinas and along the New England waterfront. Heightened non-renewal rates are also found elsewhere in the country, such as in areas affected by tornadoes and hail. Finally, while rate regulation may play a role in insurers' reluctance to do business in some markets, the most striking pattern from the data is that both premiums and non-renewal rates are higher in markets with more disaster risk. In other words, accessibility and affordability issues go hand in hand. To briefly characterize the accessibility issues, the data show that 1.9 million policies were non-renewed between 2018 and 2023. That amount represents 1.9 million times that a household had to quickly find a new insurer, very likely at a higher premium, while juggling many other expenses and commitments on their time. If non-renewal rates had stayed at their 2020 level, there would have been 423,000 fewer non-renewals. The cornerstone of the private homeowners insurance market in the United States is healthy and robust competition. When fewer insurers do business in a market, as we see now, this reduces the options available to homeowners and their ability to shop for the best rate. In the most extreme case where a homeowner cannot find any private insurer, these risks fall on state-backed insurers of last resort and potentially on taxpayers themselves. The rising cost of coverage and the departure of insurers from property markets has serious implications for home values, the dominant store of wealth for the average household. It also threatens communities that rely heavily on property taxes to provide basic services and defend against further climate-related damage. In addition, the insurance crisis raises concerns for mortgage giants Fannie Mae, Freddie Mac, and the FHA, especially as the number of outstanding flood insurance policies backed by the National Flood Insurance Program have fallen by 16% since 2009. There's an enormous imbalance between the rich data and sophisticated models that insurers have at their fingertips and the information available to the average American household or city mayor. Without adequate data, households and policymakers cannot develop meaningful solutions to mitigate growing climate-induced disaster risk. A starting point would be a coordinated federal effort to collect and distribute relevant data on insurance costs, physical risks, and resiliency investment options. I commend this committee for taking unprecedented steps to measure accessibility issues and look forward to further coordinated efforts to provide timely data to decision makers. Property insurance is facing a crisis on two pressing fronts: affordability and accessibility. While the Rolling Stones might say you can't always get what you want, in insurance markets, now households can't even get what they need. Thank you again for the opportunity to testify.
Thanks very much. For the record, that may be the first Rolling Stones reference in the history of the Budget Committee. Mr. Shigalian, welcome. Please proceed with your statement.
Mr. Chairman, Ranking Member.
Microphone on.
Ranking Member Grassley and members of the committee. My name is Ernie Shigalian. I'm an insurance agent at Butler and Messier Insurance Agency in Pawtucket, Rhode Island. We are members of the Independent Insurance Agents of Rhode Island. I'm a past president of the State Association. Independent insurance agents represent many different insurance companies at once, but are not employees of any insurer. Our customers are your constituents. I'm here to testify that the insurance marketplace in Rhode Island is the worst I've seen it in my 40 years as an agent, and getting worse each year. The increased frequency and severity of weather events has created havoc in the cost and availability of home, business, and even auto insurance. During recent years, Rhode Island's coastal communities, which are high wind risk areas, have seen a 562% increase in non-renewals. 2 insurers left the Rhode Island market during the last 2 years. One of them came to Rhode Island about 12 years ago, specializing in homeowners policies for coastal communities at reasonable rates. They are now in receivership, canceling thousands of policies midterm. A third insurer announced in 2025 they will be non-renewing all their home and auto policies in Rhode Island and all the other states where they operate. If I had a professional Christmas wish list, at the top of it would be that states required insurance companies to give more advance notice before allowing to withdraw from territories, unless they demonstrated actual financial distress. When there are non-renewals, it creates a big problem for consumers because most standard insurers won't accept new customers in coastal communities. This has increased the population in the Rhode Island Joint Reinsurance Association, the residual market, risk pool, whatever you want to call it, by 30% during the last 2 years. Consumers pay between 35 and 50% more in the risk pool for a basic homeowners policy that doesn't offer optional coverages like jewelry riders. Other consumers have no alternative than buying coverage through the unregulated surplus lines market. Insurers have had large, multi-year premium increases, contributing to the affordability problem for first-time homebuyers and putting a major strain on the budget of existing homeowners. Thousands of Rhode Island consumers have a 5% hurricane damage deductible. A homeowner with a $500,000 house would have a $25,000 hurricane damage deductible, more than most people could afford to fix their house. Massachusetts coastal communities have also had a spike in policy non-renewals. Just in Barnstable County, Cape Cod, there are 51,184 homeowners insured through the Massachusetts Property Insurance Underwriting Association, their residual market or risk pool, unable to get adequate dwelling property limits on larger homes. Businesses that own property in coastal communities have no alternative but to get coverage in the unregulated surplus lines market at a much higher cost. These insurers require non-standard exclusions that would eliminate coverage for potentially devastating property and liability losses. In recent years, we have seen more frequent incidents of sudden street flooding, causing total losses on dozens of cars each time, adding to the cost of auto insurance. Our highway infrastructure can no longer handle the increased amounts of rain in short time spans. Homes and businesses that aren't in flood zones are getting flooded. It's not just the big, well-publicized hurricane claims, but more frequent and severe local storms. In Rhode Island, since 2018, we've had 6 tornado strikes. Prior to that, it took 32 years for 6 tornado strikes. We have new weather hazards like atmospheric rivers, which cause floods through wide sections of the country, and we're seeing wildfires in places that never had them. When insurance companies don't accept millions of dollars of premiums, even at today's much higher prices, that tells me they think things are going the wrong way. Thank you for the opportunity to testify and relay the complaints that we get from our customers every single day. The crisis is not with insurance companies, the crisis is with consumers. Thank you.
Thanks very much, Mr. Shkalien. Dr. Hartwig, over to you.
Thank you, Senator Whitehouse, Ranking Member Grassley, and members of this committee. Good morning. My name is Robert Hartwig, and I'm a Clinical Associate Professor of Risk Management, Insurance, and Finance at the University of South Carolina. And prior to joining USC, I spent 23 years in the property casualty insurance and reinsurance industries, during which I had the opportunity to work on a wide variety of issues related to the industry's exposure to catastrophic loss. Let me get straight to the point. The insurance industry is not in the midst of a climate-driven crisis, nor is it about to fall. Strength and stability are the hallmarks of this industry. Indeed, a recent report from AM Best, the largest insurance rating agency in the U.S., found that the cumulative impairment rate of AM Best rated insurers over any 15-year period from 2001 through 2023 was just 0.3%. down significantly from the 3.9% over the 1977 to 2001 period. In other words, there is no evidence that the industry is on the precipice of collapse, despite material increases in insured losses arising from natural disasters over the past quarter century. There are also no insurers designated as systemically important financial institutions, or SIFIs, and since 2017, the U.S. Treasury's Financial Stability Oversight Council, FSOC, has effectively ceased relying on non-bank SIFI designations for regulatory purposes. Examining the data collected by this committee, which I received just yesterday, on non-renewal rates for homeowners insurance revealed that a small increase in non-renewal rate for the U.S. overall is largely driven by two states, Florida and California. The same pattern of increase is not observed in other large disaster-prone states such as Texas and New York, suggesting that there are idiosyncratic issues that play a major role in determining insurance availability and affordability in both of those states. In the vast majority of states, 99% plus of homeowners are able to renew their policies each and every year. Climate risk is an important determinant in the cost of insurance, but there has been a tendency, however, to over-attribute the impact of climate change when describing the state of insurance markets. The dynamics of insurance markets are far more complex than can be explained by climate change in isolation, with insured losses and ultimately the price and availability of coverage determined by a range of factors, including rapid population growth and urbanization, inflation, litigation, and fraud. To take population growth as an example, since 1970, the U.S. population has increased by 65%. In catastrophe-prone states, it's been far more than that. The population of hurricane-prone Florida, for example, is up 217% since 1970. In the Cape Coral-Fort Myers metro area, it's up 620%. Why do I bring that up? Because it's unsurprising that when Hurricane Ian made landfall in that area just 2 years ago, insured losses totaled some $55 billion, making Ian the second most costly natural disaster in U.S. history. This example vividly illustrates the dominance of demographics over climate change as a driver of insured loss. Let me move to inflation. Inflation in the U.S. in recent years reached the highest level in 40 years. Inflation directly and immediately impacted the cost of repairing and rebuilding structures damaged not only by natural disasters, but property claims of all sizes by all major perils throughout the country. Inflation, as experienced by property insurers in recent years, is actually materially higher than that as measured by the CPI. From January 2020 through June of this year, the cost of construction materials increased by 41%, nearly double the 21% of the CPI over the same period of time, whereas home insurance premiums rose by approximately 18% over that same period. So again, the economic impact of inflation on property insurance claim costs dominates any impact from climate. Let me move on to litigation and fraud. Litigiousness and fraud have also contributed to the upward trend in claim costs, driving premiums upward and reducing coverage options for some policyholders. According to the Florida Office of Insurance Regulation, that state accounted for 76% of all homeowners insurance-related litigation in 2021 nationwide, despite accounting for only 7% of homeowners' claims that year. Excessive litigation contributed not only to higher premiums in Florida, but a more than doubling in the policy count at Florida Citizens, the state's insurer of last resort. The recent leveling off in the number of policies in force in Citizens is early evidence that reform legislation passed in 2021 and 22 is beginning to improve insurance availability in that state. So let me summarize by saying that insured losses from natural disasters across the United States continue to rise, and they will continue to rise for the foreseeable future. Climate change drives incremental system costs, but the dynamic of insurance markets are complex. Many factors have contributed to the record and near-record losses experienced in recent years, including demographics, inflation, and litigation. Meaningful reforms coupled with investments in mitigation are proven solutions that can help ensure the stability of insurance markets across the country. Thank you for the opportunity to testify before the committee today. I'd be happy to respond to any questions you may have.
Thank you very much. Dr. Keyes, let me start with you. I want to show this graph from our report, which compares the non-renewal rates that we found across the country over time and breaks them out into the various climate risk quintiles. It appears that depending on your quintile, lowest climate risk, lowest non-renewal rate increase, higher climate risk, higher climate rate renewal increase, and all the way up to in the top quintile where the non-renewal rate really is growing explosively. That is the information that we gathered. How does that correlate with what your work shows?
Well, thank you, Senator. I think that this is the most striking chart in the report and the data that's been shared with me, very clearly seeing an extremely sharp and differential increase in those riskiest, most exposed counties. I think one of the other striking takeaways is how much variation there is within states. And so even in a state that might have the same regulatory regime across the entire state, you see very different patterns, say, along the Carolina coast.
So before you go to that,
yes,
let me just go back. More climate risk, higher non-renewal rates.
dramatically.
Is that correlation consistent with what you see through your own research?
Yes, much higher non-renewal rates here, much higher premiums in the
Now
premiums.
let's flip to your second
analysis.
point, which coincidentally I want to illustrate with a second graph. So we have graphs in the report that show the state level of non-renewals. And unsurprisingly, Florida and Southern California, where their wildfires are very significant. But once you actually drill down to the county levels, as you were beginning to describe, I believe, which is why I wanted to put this graphic up, then you begin to see things break out that are a little unexpected. I mean, obviously, every county in Florida is in big trouble with very high non-renewal rates. But if you look up, for instance, at New York doesn't even appear in the top 30 states, I don't believe. It's not particularly troubled from a non-renewal point of view. But when you drill down to the counties and you look at, say, a coastal county on Long Island, suddenly you see the same explosive growth in non-renewal rates and the same high non-renewal rates that you see. Could you comment a little bit on what drilling down to the county level shows us about how this non-renewal crisis is developing?
Yes, thank you. I think it reinforces this this takeaway along the lines of the last figure you showed, which is that there is differential risk, and that especially exposed counties are seeing much sharper changes in the availability of insurance. We're also seeing that that's related to the price of insurance as well. So certainly related and very much concentrated in the highest climate risk areas, especially along the coasts, but also in areas, as you mentioned at the outset, like in Oklahoma and parts of New Mexico.
Which would suggest that insurers are making highly localized risk-based decisions when they're deciding to non-renew and not just writing off all of New York or something like that. They're really drilling down and looking closely at individual properties and property owners. Mr. Shigalian, is that what you're seeing in Rhode Island? Do you think the insurers are can differentiate between coastal properties, for instance, and others?
So what I see in Rhode Island,
If your microphone's not on, please turn it on.
it's on, I guess.
Okay, good.
Yeah, so what I see in Rhode Island is most insurers have like a mileage, if you're within 3 miles of the coast, then you've got problems. In Rhode Island, as you know, if you're in Forster, Rhode Island, or you're in 10 miles, 12 miles inland, it's not that much of a problem. So it's predominantly the coastal communities.
And I understood Dr. Hartwig's testimony to be basically insurance is sound, insurance is stable, nothing to see here, folks, not a problem. How does that correlate with your experience with your clients in Rhode Island? Are they seeing that everything's fine and there are no problems?
So there's no problem with the insurance companies. The problem is with the consumers that are being forced into risk pools, being forced into the surplus lines markets, being forced to pay more money for the insurance, and having less availability of optional coverages.
My time's up, Mr. Chairman.
Thank you. Thank you. Dr. Hartwig, is there any evidence that over the past quarter century, insurance companies have had an increased failure rate because of climate change?
Thank you, Senator. In fact, there's no evidence that over the past quarter century that there has been any increase in the failure rate, the rate of insolvencies, the rate of impairment, as we typically refer to it, with respect to property casualty insurance or reinsurance companies as a result of climate change, or quite frankly, for any other manner. The data I cited earlier from AM Best, the premier rating organization of insurers in the United States, is quite clear on this, that in fact, the insolvency rate, the impairment rate of insurers has actually fallen dramatically over the past quarter century. So what this shows is that insurers have done a good job of managing this risk. What insurers are doing is trying to make insurance available everywhere that they can, but they can only do so if they can earn a fair rate of return. Going back to the figures that Professor Keyes just showed, as he acknowledged in his testimony, that the numbers overall are very, very heavily influenced by Florida and California. Okay, and when we look at those two states have structural issues with respect to, I'll take Florida for example, absolutely rampant legal abuse in the system that drove up system costs and was in fact the principal factor associated with the impairment of a number of insurance companies in that state, okay, leading to an explosive growth in the state's market of last resort. Very fortunately, we've had a series of reforms in recent years, and in fact, Chart 2, Exhibit 2 in my testimony, what you see is that the non-renewal rate in Florida in fact, seems to have peaked at around 3%, even went down slightly in 2023. Those reforms took place in 2022 at the very end of 2022, so are really bearing fruit just this year. So I expect to see, in fact, the non-renewal rates in states like Florida fall. California has been a bit slower. They've been slow to come around to the realization of reform. They finally signed on to that. Some of those reforms will go into place in 2025. Some of them went into place this year. We would expect to see a turnaround there. And in both states, we are seeing insurers signal that they are coming back into the marketplace as a result of the reforms. They're not talking about climate. They're talking about the obstacles to writing coverage in these states is related to the legal environment associated with those states. Obviously, there's the explosive population growth, and then, of course, the pressures associated with inflation.
I think you've answered this question, but I'm going to ask it anyway, and I'll let you decide if you've answered it. Are fraud and litigation major drivers of the insurance prices, and what can state governments do to limit the effect of these factors have on insurance costs?
Right. So, yes, in my response to the last question, I think I discussed quite a few of these things. But when we think about, let me give you an example in Florida to be very concrete. And Florida's problem, which again is often ascribed to climate, and not to say that climate is not a driver of loss, but Florida's problems and California's problems are largely man-made disasters. Okay, in the state of Florida, for instance, an issue called assignment of benefits, which I didn't see reported at all in the report that we received yesterday, not discussed at all. This is a situation which, to my knowledge, is relatively unique in the country, where a policyholder can say to a roofing company, hey, guess what? I'm going to turn my policy effectively over to you. You deal with the insurance company. Well, what do you think is going to happen when you have a bunch of roofers that are now in charge of millions of people's insurance policies? They're going to knock on everyone's door and get every roof in the entire state to try to be replaced, even when it doesn't need to be replaced. This results in immense amounts of litigation. For which insurers had not priced into the policies. Their only thing that they could do at that point is essentially impose moratoria on writing new policies until the situation was solved from a regulatory perspective. And that's exactly what happened in 2022 when Governor DeSantis called 2 special sessions of the legislature.
Dr. Hartley, my last question. Democrats intentionally withheld their new staff report on the effect of climate change on insurance. As a result, my staff didn't have an opportunity to fully review their findings prior to the hearing. However, they did provide raw data concerning non-renewal. What stuck out to you in your review of this data?
Right, so I was in the same boat, of course, not receiving I received a spreadsheet with absolutely no detail as to actually what it was yesterday, but looking at it quickly. So as I mentioned, the U.S. non-renewal rate is greatly influenced by two states, California and Florida. If you back those out, and in fact, in Exhibit 2, in my analysis of my testimony, I show a column, rightmost column is called median state. Median state, the variance in median state from 2018 non-renewal rate to 2023 goes from 0.79% to 0.86%. Very little variation. So across the country, when you look at the individual state experience, again, this is why I say 99% plus of policyholders across the country are able to renew their policies in virtually every year without a problem. I see that Florida's non-renewal rate has leveled off. And I would expect California within a year or two to see the same pattern. But again, the fact that large disaster-prone states like Texas and New York do not mirror the pattern we're seeing in states like California and Florida suggests that something else is at work. And that something else is not more climate change related pressures in Florida than there are in Texas. Lord knows we've had a huge number of disasters in Texas. But Texas went through its cathartic moments in terms of problematic regulation of the insurance industry 15 or so years ago. They understand now that they need to create a market that attracts capital in a place that's always going to be risky, and so far so good.
We have Senator Padilla, then Senator Kennedy, then Senator Kane, then Senator Braun. Senator Padilla.
Thank you, Mr. Chair. As you've led discussion in this committee in the past, we, I think, acknowledge that the federal government needs to step up to increase coordination between states and insurance providers and help equip stakeholders with mitigation tools and help identify potential solutions to the clear insurance crisis. Now, California has invested billions of dollars in wildfire risk reduction and implemented a number of programs designed to incentivize homeowners and businesses to make safety improvements. The federal support for such risk mitigation measures, infrastructure and home hardening, and community-wide resilience could better equip states to get creative on how to manage the insurance markets and affordability challenges. Dr. Keyes, would you agree or disagree that there is space for the federal government to constructively engage on this issue to help communities, to help states, to help industry better navigate the climate-led changes to the home insurance market?
Well, thank you, Senator. I completely agree. I think that when we look at the landscape of property insurance, it's a market that's regulated at the state level, and so you have a lot of inconsistencies in terms of what data is provided to consumers, what the regulatory landscape looks like for the insurers. We're operating in almost total darkness when it comes to data in this market, and it's really through the efforts of this committee to get a glimpse into non-renewals. But if you think about all the other margins along which insurers are collecting sophisticated data and acting on that data, there's really no coordinated effort to understand their actions. So I think there's a very clear role for at the federal level to coordinate these efforts in terms of collecting data, better communicating risks to communities, and then to your point about mitigation, developing best principles for acting on that data and reducing risk. I think the risk is really not in the insurance industry per se. The risk is really about managing risk for households and communities.
Okay. No, thank you. That's actually very, very helpful. Now, as we make progress on the data points that you just made and other tools and solutions, how would you address the concerns of skeptics who would say, how is this actually going to translate into lower insurance premiums for families as opposed to just increasing profits for insurers?
I think this is one of the challenges right now is understanding a bit more about how pricing works in this space and how much of that is really trying to meet the costs that insurers are facing versus, to your point, towards the profitability of issuing these policies. What we're seeing in many markets where the insurers are stepping back is we're seeing now an increased dependence on these state-run entities. They are going to have the data on how much it costs to insure these properties. And so I think there is another layer of information that can be communicated there. And then I think just risk mitigation more broadly is actually a win-win, and that it's good for the insurers because they have to pay out less, and it's good for the households, and it's also good for the mortgage market. And so we have to remember the chain here, which is that without good insurance, you can't get a mortgage. Without a mortgage, you can't buy a house. And the mortgage market is one of the direct beneficiaries of this insurance landscape. And so I think we should think about them as well when we're thinking about who should bear some of the costs going forward to put together better information for households to make these kinds of mitigation choices.
Okay. Thank you very much. And Mr. Chairman, Nevada County in California was highlighted in the Budget Committee's report. And I do have a letter I'd like to submit into the record from Nevada County Supervisor Heidi Hall addressing the local impacts of the climate-driven insurance crisis. I think it would be it's helpful perspective to add to this hearing and our
Without
deliberations.
objection.
Thank you. Thank you, Mr. Chair.
And I should note that Senator Dawn Oyer from Rhode Island is here. She represents Newport County, which is the county that our data shows has the highest non-renewal rate, highest non-renewal increase rate in Rhode Island, consistent with the observations of Mr. Shigalian that the insurers are withdrawing from or raising rates dramatically in or forcing people into the assigned risk pool along the coastal high-risk climate areas. And that takes to Senator Kennedy of Louisiana.
Thank you, Mr. Chairman. Dr. Keyes, Professor Keyes, are you clairvoyant?
Thanks for the question, Senator. No, I'm not.
I'm not either. So when you make predictions, these are my words, not yours. When you make predictions that climate change is going to destroy home ownership and the insurance market and otherwise cause the earth to spin off its axis, those predictions are made on the basis of climate models, is that right?
The forward-looking forecasts are based on models. My discussion was retrospective and focused on the data we've collected over the last 5 years.
If those models are wrong, then your predictions would be impacted, wouldn't they?
Senator, I would say that the famous quote is that all models are wrong, but some are useful. And in this case, there's a preponderance of evidence that suggests the direction that climate's headed.
Methanethiol?
I'm not aware of that term, Senator.
I'm surprised. I've read a lot of your writings. You seem to fancy yourself as a climate expert.
Senator, I'm an expert on housing markets, mortgage markets, and insurance markets. I'm not a climate scientist.
If I told you that methanethiol is a sulfur-based aerosol gas, kind of smells like rotten cabbage, that is produced by microscopic plankton in all of our oceans, which cover 75% of the Earth's surface. Would you have reason to disagree with me?
I certainly wouldn't, Senator. I'm here to talk about insurance.
If I told you that this methanethanol is an aerosol, which escapes into our environment, it oxidizes and produces particles that substantially reflect the sun's radiation and heat and prevents climate change. Would you have a reason to disagree with me?
I wouldn't, Senator. I'm here to talk about the insurance crisis.
I know you don't want to talk about things that undermine your confident assertions, but this is important. The Institute of Marine Sciences and the Cabrera Institute of Physical Chemistry just a few days ago published a startling study. It's being widely reported. And it found that while scientists and these climate change models on which you rely have always known about methanethiol, that now science has discovered ways to better measure it, and that it demonstrates that there's 25% more methanethiol being released into our atmosphere than any scientist ever thought. And that's going to have a huge impact on cooling the earth, and we're going to have to recalibrate all of our climate change models. I suggest you read it, Doc. I see this essay that you wrote in the New York Times, appropriate, New York Times. Climate change should make you think homeownership. Did you write that?
Yes, I did, Senator.
It's pretty bold. You own a home?
I do, in a flood zone.
Have you sold it?
Have I sold my home?
Yeah.
I live in my home, sir.
Oh, well, you're telling everybody else to sell theirs. You're a climate extremist, aren't you, Professor?
Certainly not, Senator.
You are a political extremist, aren't you?
Certainly not, Senator.
On July 9th of 2024, did you tweet the following, quote, "Honestly, the biggest long-term political problem the Democrats have is that they don't know how to talk to low-information morons," close quote.
I don't believe those are my words, Senator. I'd have to be able to see them if you would share that with me.
Yeah, here it is, big as Dallas.
I don't believe those are my words, Senator.
You tweeted them.
I don't believe that I did.
Yes, you did.
I may have liked someone else's tweet or retweeted someone else's tweet.
Do you
Those
often
are not my words.
like tweets you don't agree with?
Those are not my words, Senator.
Yeah, but you tweeted them in approval, didn't you? You
Those are
can't
not-
make this cat walk backwards, Professor.
Those are
On
not
July
my,
16th,
those are not my words, Senator.
2024, did you tweet the following, quote, "A big part of modern right-wing culture is this frisson of the illicit. The reading of this or that writer or account that are outre in whatever ways, fascist, race IQ obsessives, Holocaust denial adjacent, people with very weird sexual fixations and pathologies they turn into their own philosophy, etc. A lot of them, and I think this is true of Vance, and definitely true of the creepy Silicon Valley MAGA weirdos, have simply pickled their brains," end quote.
Again, Senator, those are not my words, and I did not
Tweeted them,
tweet.
Professor.
I did not tweet that, sir. Those are not
Senator
my
Kennedy,
words.
Let me make this last point. You've got
for more
a lot
than
of
2 minutes
nerve.
over your time. We
You've
have
got
other
a lot of
senators
nerve,
waiting.
Professor, coming
You
here
always go over your time
and,
so that I have to call it
and lecturing
for
us
you.
about Holocaust denial
But
being
really,
from the University of Pennsylvania.
You have other senators who are waiting for their time, and you're well over yours.
Thank you for your indulgence, Mr. Chairman.
Senator Kane.
Thank you, Mr. Chair. You noted that one of the witnesses used a Rolling Stones lyric, so I'm going to use one. "Oh, a storm is threatening my very life today. If I don't get some shelter, I'm going to fade away." So I'm going to ask one question about shelter and one question about storms. So on the shelter question, I'd sort of like to address to Professor Keyes and Mr. Shigalian. I'm not thinking about climate models in this hearing. I've certainly thought about them in other hearings. I'm just thinking about the experience of Virginians who are trying to get homeowners insurance or flood insurance and what I hear from them. And I think that's the data that this hearing really is digging into. Let's talk a little bit about what that means if somebody's home is uninsurable. For most Americans, middle-class Americans, their home is their principal source of wealth. It's their most significant asset. It is the asset whose appreciation and value also is often the beginning of a family being able to, over generations, amass more and more wealth. So let's focus on that. If you live in an area where suddenly you can't get insurance, or when you're trying to sell your home and realize that wealth, purchasers are reticent to purchase because they have a hard time getting insurance. What does that do to families in these areas? And we have them in Virginia too, Portsmouth and the Hampton Roads area. Mr. Shigalian, if you could go first.
Yes, so, yes, especially with flood insurance, what you're saying is true, that if you go to sell your house and the buyer finds out that the flood insurance, sometimes it's $15,000, $20,000, $30,000 for flood insurance, that can, it can almost be that you can't sell the house. And in the flood insurance, I mean, the federal government, they make the rules and basically set the prices. And even though there's some private insurance out there now, the private insurance markets can decline people. So that, that can be another problem. It's not a relief valve for everybody.
So either you might not be able to sell your house, or you may have to sell it at a really significant discount because of the flood insurance cost.
The buyer, is not going to be willing to pay the same price if they know they're going to pay, a lot of money for flood insurance.
There are neighborhoods in the Hampton Roads area, Virginia, Portsmouth, for example, beautiful historic neighborhoods where flooding used to be very rare and it's now quite common. And it's very, very difficult for people to sell their homes for example, what they purchased the homes for. And so we see this again and again. And then Dr. Keyes, talk a little bit about what effect that has then on a family's ability to use this principal asset to have wealth.
Well, thank you, Senator. That's right. This is a challenge where you're going to be facing rising costs year over year. I think a lot of people think of home ownership as a way to lock in their housing costs. You take out a fixed rate mortgage, you have a predictable payment that you're going to be able to deal with each year, and changes in homeowners insurance is undermining that predictability. And so now you have this additional uncertainty into what your actual outlays are going to be to live in that home, and that's going to be really challenging.
So there's an additional cost in the short term, and then a probable decline in the wealth and the value you get out of the asset in the long term. Let me switch to asking about storms. We're working on a supplemental bill today to deal with natural emergencies. Actually, the bill is now what I would call a real disaster supplemental. A lot of it is about the natural disaster, Hurricane Helene and others, but some of it is about a predicted man-made disaster, namely, if tariffs are put in place, people will get hit so badly that we've had to put money into the disaster bill to compensate for the predictable man-made disaster of a Trump tariff policy, which I think is interesting. So this disaster bill has grown in scope to encompass both natural and man-made disasters. But look, Hurricane Helene in particular hit Southwest Virginia, Appalachian Virginia very hard. And I've been there to see the damage to homes, to businesses, to national parks and forests, which kind of drive economic activity, to infrastructure like roads washed out. And what we're seeing in Appalachian, I just looked at some of the data, Mr. Chair, is we're seeing some of the highest non-renewal rates. We certainly see them in coastal Virginia. We're starting to also see them in Appalachian Virginia, because even if annualized rainfall isn't changing that much, we're seeing rainfall and storms come much more episodically and unpredictably. And the infrastructure that's been built based on kind of norms and averages in these hollows, whether they be roads or schools or homes, they're not an infrastructure that can withstand abnormal weather patterns. And so we're seeing significant effects, and then that is also, at least there appears to be some correlation. I don't know that I know enough about the report yet to talk about causation, but we're starting to see non-renewal rates tick up in Appalachia as well. So I appreciate the work that the committee has done to surface this non-renewal issue. I do think this is an area where we're seeing it, sure, we're seeing it in Florida and California, and I recognize that they've had some challenges that are severe on the climate side. We're starting to see it in Rhode Island, we're starting to see it in Virginia, including in places in Virginia where we wouldn't have predicted 10 years ago. I appreciate the committee for holding this hearing.
Thanks, Senator Kane. Senator Lujan.
Mr. Chairman, thank you very much, and thank you for holding this important hearing. Mr. Chairman, I also want to thank you for the work that this committee has done throughout this Congress, which has been abundantly clear about the concern that families all across the country are faced with. And as we've seen with these most recent natural disasters, our brothers and sisters throughout the United States that live in some of the most rural areas, folks that still don't have running water, it's absolutely devastating what we're seeing as a result of hotter temperatures, drier conditions in the Mountain West, the West with these wildfires, the intensity of hurricanes. In the end, this is all impacting the cost of living for people all across America, which brings me to this hearing, Mr. Chairman. The climate risks like natural disasters have created a homeowner's insurance crisis as well. And with it, real pain and anxiety for communities in states like mine. We know that the climate crisis is driving higher insurance premiums and non-renewal rates, leaving entire regions vulnerable when another disaster strikes. And based on data collected during this committee's investigation, it's the communities that are most vulnerable to these risks that need protective insurance policies the most. What we're seeing in New Mexico and most parts of the country, it's rural areas experiencing the highest increases in premiums and non-renewals. In New Mexico, more extreme and frequent wildfires pushed insurers to refuse renewing or approving policies in areas at high fire risk. It happened after the Hermit's Peak Calf Canyon fires in 2022. A fire, by the way, that was started by the federal government, a prescribed burn that was never put out, that resulted in the state's largest fire in our history. It happened after the South Fork and Salt fires in Ruidoso earlier this year, and I'm fearful that it will happen again. So, Dr. Keyes, yes or no, does refusing to renew home insurance plans after a natural disaster add to the challenges of the recovery process?
Yes, if insurers are exiting the market in the aftermath of the disaster, that's going to leave fewer options for homeowners as they seek to rebuild and reestablish the community.
The Ruidoso fires this year destroyed or badly damaged more than 1,100 homes, but only around 10% had adequate insurances according to estimates. As climate impacts worsen, that number will fall even further. For those that want to rebuild their lost homes, the question now is where? What options do families have if companies refuse to insure their property or choose to cancel their insurance plans years later? The questions that my colleague from Virginia, Mr. Kane, was asking clearly articulate that. Now, to many in my state, picking up and moving elsewhere isn't just financially difficult. These are families that have been there for generations. Lands that have been held in the family for centuries. And because someone somewhere with some methodology, some actuarial says, nope, can't build there. We're not going to insure you there. I have a real problem with this. This is a pocketbook issue. Now, Dr. Keyes, yes or no, for those homeowners lucky enough to have their insurance policies renewed, does skyrocketing home insurance premiums make it more difficult to families to recover from natural disasters?
Thank you, Senator. It makes it much more difficult to recover from a household budget standpoint if they are now spending a significantly larger amount of their annual income towards homeowners insurance.
I appreciate that response. And Mr. Chairman, I appreciate all the conversations in the hearing today, but what you've clearly demonstrated is this is a pocketbook issue. This is something we should all be talking about more. This shouldn't be partisan. Families in states that are represented by Republican members of this body or Democratic members of this body that voted for the incoming president or the current president, everyone's getting hit with this. And I can't thank you enough for having this conversation, and especially what the people that I'm fortunate to represent have been going through back home. This is not right. So whether it's through this body or state by state with superintendents of insurance, someone's got to do better. And we need to make sure that we keep families at the center of all of these decisions and understanding what's happening to them when they get kicked in the face with these pocketbook issues that are just getting worse and worse. So thank you very much, Mr. Chairman. I appreciate all the experts for being here today.
I believe Senator Merkley is trying to get here. So I'll take just a moment of chairman time. I can recall driving along the Gulf Coast on some of my climate travels to red states. And as Mr. Shigalian will know, when a property is up for sale, there's a sign out front that hangs the name of the real estate company that is selling the property, and then underneath that, there's another little sign that gives you the name of the individual realtor in the real estate company, who's the person to contact if you're interested in buying the home. And what I saw over and over again was that underneath that plaque with the individual realtor's name was another little plaque that said what the height above sea level was of the property. That was such important information along that Gulf Coast that they were literally hanging it off the real estate sign of the properties that were for sale, because if it's low, then that means the flood risk is huge, and the person driving by is just going to keep on driving. But if it's got enough altitude above sea level, well, maybe they'll be interested. The other thing that I wanted to say in response to the testimony about the litigation problem, I'm not expert like the panel, but I'm not a rookie either. I ran the Rhode Island Attorney General's Office regulatory unit, which included insurance rate cases. I was the insurance regulator for the state of Rhode Island. I came back as Attorney General and oversaw the insurance rate work of the Attorney General's office. I helped lead our rebuild from an epic insurance failure, the RISDIC failure, a deposit insurance failure, which Mr. Shigalian will remember. And I was the architect, I guess I'd say, orchestrator of the workers' comp insurance reform that we had, which has worked. And after we had a workers' comp failure in which every single insurer left the state, announced their departure. So what's happening in Florida has some resonance for me. But I've also been around this conversation in which the insurance industry blames things on litigation. And I just want to offer my own experience in this regard, which is that litigation goes up when insureds are getting screwed. If you don't want a lot of litigation, pay claims fully and promptly, and that really helps solve the problem. If you look at Florida, we're seeing Citizens Property Insurance reporting 70% claims denial for individual storms. 70% of claims filed with that insurer are just denied. You got to have a hell of a fraud epidemic if you're telling me that 70% of Floridians are fraudsters and that their claims should be summarily denied. When your claim is just auto-denied, and by the way, there's some logic to this. When claims are denied, it puts people under more and more pressure. They may not be able to stay in their houses if they're not livable. They may move someplace else to a cousin out of state. And at that point, fighting with the insurance company really doesn't make any sense any longer. You just wash your hands. You don't pursue the claim. No, you may not interrupt me. And the problem defaults to the bank that owns the mortgage. They now own the ruined property. So there's some real logic, unfortunate logic, but real logic to running up your claims denial rates. We've also seen long delays in payment. You know, ultimately you may get paid, but if you can't live in the house, if you can't fix it in time, if mold grows, if we saw it in Katrina, people moved to Texas to get away from the disaster, and they got resettled. They found a new job. They didn't want to come back, and the claims just languished. We saw 60 Minutes go through the insurance adjusters of Florida, relating stories about how they would go, they're independent insurance adjusters, they would go to the insured's home, they would look around and they would say, okay, here's the damage, here's how much it should cost, and then the insurance company would rewrite the adjuster's report and just remove stuff. Well, if you're the insured and it's your home and you know from your adjuster what he told the insurance company, then the insurance company comes back and says, you know, you get $20,000 on a $200,000 adjuster. What are you going to get? You're going to get litigation. So there are two sides to this story. I've been hearing this for as long as I've been around insurance. The insurance industry loves to blame litigation, but a great deal of the litigation has to do with the way the insurance industry treats its customers. And that is the experience that I have had. Mr. Hartwig has expertise in this area. He has the view that he expressed, that it's actually the litigation that is driving the insurance costs. I just wanted to offer back my experience, having been through this argument for decades now, that there's a very strong counter-narrative about that, which is that if you want less litigation, pay the damn claims. Be solvent, pay the claims, pay them quickly, pay them fully, and then the litigation abates. So that is my experience. You wanted to say something, Mr. Hartwig?
Yes, thank you very much. So I would say that Florida did have a hell of a fraud problem. And a hell of a
70%? 70% of Floridians are fraudsters? Is that what you're
I
telling us?
don't think anybody is saying that. But what we are saying
Well, it's the
is
thing
a
you
problem
deduce
that
if you looked at a
costs-
70% claims denial rate for a storm, isn't it?
There's in
If
the
you're
state of
ascribing
Florida,
that to fraud, you're
3%.
saying that they're fraudsters.
3% is the non-renewal rate in that state. And so, and let me speak to some of these other things. So for instance, in a prior role, when I ran the Insurance Information Institute and as its chief economist, in the wake of Hurricane Katrina, 1.75 million claims, largest ever, and even to this day, it's a record. We did do a study at 6 months and 1 year and found that approximately 1% of those claims were in dispute. By that, I mean they weren't fully settled within about 6 months, and it was about 0.5% after 1 year. This is after the largest claiming event ever in United States history. So my experience is that, and even my personal experience, having my first ever homeowner's insurance claim with Helene a couple of months ago, is that the claims are settled fairly and expeditiously, and there are fair claims handling acts
I'm not
in
disputing
all
that from
50
time to
states that
time, the
protect
insurance
consumers.
industry, in fact, perhaps even most of the time, they pay their claims expeditiously. Rhode Island is the home of Amica. They're legendary
They're a
for
great
their
company.
good payments and quick behavior. But where litigation is the issue, I contend that there is a case to be made that very often the litigation is the product of the behavior of the insurers. And when you've got 70% claim rates, when you've got documented cases of adjusters' reports being whittled away by the insurance company, I mean, that is what you then get. You create a litigation environment that you can then blame for your problems.
So
We're going to disagree. I'm going to call this hearing to an end. I wanted to make sure that both sides were reflected. You have made your statement, I have made mine. People can make their own determinations about it. I want to thank all of you for appearing before the committee today. Each of your full written statements will be included in the record. If there are questions for the record, please get them into us by noon tomorrow. Any members who are interested in that. And we will ask the witnesses, if you do get questions for the record, to respond within 7 days of when we get them to you. And I'll make a final statement, which is that 42 hearings in the Budget Committee is quite a lot. 21 of them took on, or 22 of them, I guess now, took on a really challenging issue that required a lot of work and required bringing in really renowned expert witnesses. And I particularly just want to thank my staff director and his team for the enormous amount of work that went into building that body of evidence, which I think has helped people understand that the climate crisis that is coming our way is not just about polar bears, and it's not just about green jobs. It actually is coming through your mail slot in the form of insurance cancellations, insurance non-renewals, and dramatic increases in insurance costs, sometimes tripling or quadrupling. So with much appreciation to the team that helped this happen. Again, my thanks to the witness, and particularly to Mr. Shigalian for his trip down from Rhode Island. He's a leader in our Rhode Island community and a wonderful guy. So glad to have you here, sir. And with that, for the last time, we're adjourned.